This was supposed to be a very solid company, no worries about your future, right? If you come from a small dot-com startup, you go to Enron to have a safe future, but that's that's no longer there.
The story of Enron depicts a company that reached dramatic heights only to face a dizzying fall. The fated company's collapse affected thousands of employees and shook Wall Street to its core. At Enron's peak, its shares were worth $90.75. Just prior to declaring bankruptcy on December 2nd, 2001, they were trading at 26 cents. To this day, many wonder how such a powerful business, at the time one of the largest companies in the United States, disintegrated almost overnight. Also difficult to fathom is how its leadership managed to fool regulators for so long with fake holdings and off-the-books accounting. Enron's energy origins. Enron was formed in 1985 following a merger between Houston Natural Gas and Omaha, Nebur-based Internorth. Following the merger, Houston Natural Gas's chief executive officer, CEO, Kenneth Lay, became Enron's CEO and chair. Lay quickly rebranded Enron into an energy trader and supplier. Deregulation of the energy markets allowed companies to place bets on future prices, and Enron was poised to take advantage. In 1990, Lay created Enron Finance and appointed Jeffrey Skilling, whose work as a McKinsey & Company consultant impressed Lay to head the new corporation. Skilling was then one of the youngest partners at McKinsey. Skilling joined Enron at an auspicious time. The era's minimal regulatory environment allowed Enron to flourish. At the end of the 1990s, the dot-com bubble was in full swing, and the Nasdaq hit 5,000. Revolutionary internet stocks were being valued at preposterous levels, and consequently, most investors and regulators simply accepted spiking share prices as the new normal. Mark-to-market. One of Skilling's early contributions was to transition Enron's accounting from a traditional historical cost accounting method to a mark-to-market, MTM accounting method, for which the company received official U.S. Securities and Exchange Commission, SEC, approval in 1992. Some believe MTM was the beginning of the end for Enron, as it essentially permitted the organization to log estimated profits as actual profits. Enron hailed for its innovation. Enron created Enron Online in October 1999. It was an electronic trading website that focused on commodities. Enron was the counterparty to every transaction on EOL. It was either the buyer or the seller. To entice participants and trading partners, Enron offered its reputation, credit, and expertise in the energy sector. Enron was praised for its expansions and ambitious projects and was named America's most innovative company by Fortune for 6 consecutive years between 1996 and 2001. Blockbuster's role. One of the many unwitting players in the Enron scandal was Blockbuster, the former video rental chain juggernaut. In July 2000, Enron Broadband Services and Blockbuster formed a partnership to enter the burgeoning video-on-demand market. The VOD market was a sensible pick, but Enron started logging expected earnings based on the expected growth of the VOD market, which vastly inflated the numbers. By mid-2000, EOL was executing nearly $350 billion in trades. When the dot-com bubble began to burst, Enron decided to build high-speed broadband telecom networks. Hundreds of millions of dollars were spent on this project, but the company ended up realizing almost no return. When the recession hit in 2000, Enron had significant exposure to the most volatile parts of the market. As a result, many trusting investors and creditors found themselves on the losing end of a vanishing market capitalization. The Wall Street darling crumbles. By the fall of 2000, Enron was starting to crumble under its own weight. Skilling hid the financial losses of the trading business and other operations of the company using MTM accounting. The company would build an asset, such as a power plant, and immediately claim the projected profit on its books, even though the asset didn't return a dime to the company. If the revenue from the power plant was less than the projected amount, the company would then transfer the asset to an off-the-books corporation instead of taking the loss. the loss would go unreported. This type of accounting enabled Enron to write off unprofitable activities without hurting its bottom line. The MTM practice led to schemes designed to hide the losses and make the company appear more profitable than it really was. To cope with the mounting liabilities, Andrew Fastow, a rising star who was promoted to Chief Financial Officer, CFO, in 1998, developed a deliberate plan to show that the company was in sound financial shape despite the fact that many of its subsidiaries were losing money. How did Enron hide its debt? Fastow and others at Enron orchestrated a scheme to use off-balance sheet special purpose vehicles, SPVs, also known as special purposes entities, SPEs, to hide Enron's mountains of debt and toxic assets from investors and creditors. The primary aim of these SPVs was to hide accounting realities rather than operating results. Jim Chanos' short trade on Enron. Jim Chanos of Kinnikos Associates is a well-known short seller. At an SEC-led roundtable on hedge funds in May 2003, Chanos said that his interest in Enron and other energy trading companies was piqued in October 2000 after a Wall Street Journal article pointed out that many of these firms employed the gain-on-sale accounting method for their long-term energy trades. According to Chanos, his experience with companies that had used this accounting method was that management had too great a temptation to be overly aggressive about making assumptions regarding the future, and earnings could effectively be created out of thin air if management was willing to push the envelope by using highly favorable assumptions. Chanos also noted that Enron's cost of capital was closer to 9% and likely above the 7% return on capital, a widely used profitability metric that it claimed to have, which meant that it was not really earning money despite reporting profits to its shareholders. Chanos said that this mismatch of Enron's cost of capital and its return on investment, ROI, became the cornerstone of his bearish view of Enron. His firm then began shorting Enron's common stock for its clients in November 2000. This short trade netted Chanos and his Kinnikos firm hundreds of millions in gains when Enron went under. Arthur Andersen and Enron. In addition to Fastow, a major player in the Enron scandal was Enron's accounting firm, Arthur Andersen LLP, and partner David B. Duncan. These men oversaw Enron's accounts. As one of the 5 largest accounting firms in the United States at the time, Andersen had a reputation for high standards and quality risk management. However, despite Enron's poor accounting practices, Arthur Andersen offered its stamp of approval, signing off on the corporate reports for years. By April 2001, many analysts started to question Enron's earnings and transparency. The shock felt around Wall Street. By the summer of 2001, Enron was in freefall. Lay retired in February, turning over the CEO position to Skilling. In August 2001, Skilling resigned as CEO, citing personal reasons. Around the same time, analysts began to downgrade their rating for Enron stock, and the stock descended to a 52-week low of $39.95. By October 16th, the company reported its first quarterly loss and closed its Raptor SPV. This action caught the attention of the SEC. A few days later, Enron changed pension plan administrators, essentially forbidding employees from selling their shares for at least 30 days. Shortly after, the SEC announced it was investigating Enron and the SPVs created by Fastow. Fastow was fired from the company that day. The company also restated earnings going back to 1997. Enron had losses of $591 million and $690 million in debt by the end of 2000. The final blow was dealt when Dynegy, a company that previously announced it would merge with Enron, backed out of the deal on November 28th. By December 2, 2001, Enron filed for bankruptcy. Criminal charges. Arthur Andersen was one of the first casualties of Enron's notorious demise. In June 2002, the firm was found guilty of obstructing justice for shredding Enron's financial documents to conceal them from the SEC. The conviction was overturned later on appeal, but the firm was deeply disgraced by the scandal and dwindled into a holding company. A group of former partners bought the name in 2014, creating a firm named Anderson Global. Several of Enron's executives were charged with conspiracy, insider trading, and securities fraud. Lay, Enron's founder and former CEO, was convicted on 6 counts of fraud and conspiracy and 4 counts of bank fraud. Prior to sentencing, he died of a heart attack in Colorado. Fasto, Enron's former star CFO, pleaded guilty to 2 counts of wire fraud and securities fraud for facilitating Enron's corrupt business practices. He ultimately cut a deal for cooperating with federal authorities and served more than 5 years in prison. He was released from prison in 2011. Former CEO Skilling received the harshest sentence of anyone involved in the scandal. In 2006, he was convicted of conspiracy, fraud, and insider trading. Skilling originally received a 17.5-year sentence, but in 2013, it was reduced by 14 years. As a part of the New Deal, Skilling was required to give $42 million to the victims of the Enron fraud and to cease challenging his conviction. Skilling was originally scheduled for release on February 21, 2028, but was instead released early on February 22, 2019. New regulations after scandal. Enron's collapse and the financial havoc that it wreaked on its shareholders and employees led to new regulations and legislation to promote the accuracy of financial reporting for publicly held companies. In July 2002, then-President George W. Bush signed into law the Sarbanes-Oxley Act. The act heightened the consequences for destroying, altering, or fabricating financial statements and for trying to defraud shareholders. The Enron scandal resulted in other new compliance measures. Additionally, the Financial Accounting Standards Board, FASB, substantially raised its levels of ethical conduct. Moreover, company boards of directors became more independent, monitoring the audit companies and quickly replacing poor managers. These new measures are important mechanisms to spot and close loopholes that companies have used to avoid accountability. At the time, Enron's collapse was the biggest corporate bankruptcy to ever hit the financial world. Since then, it has been surpassed by the bankruptcies of other former giants, including Lehman Brothers, Washington Mutual, WorldCom, and General Motors. The Enron scandal drew attention to accounting and corporate fraud as its shareholders lost $74 billion in the 4 years leading up to its bankruptcy, and its employees lost billions in pension benefits. So there you have it, the gripping saga of Enron's rise and fall, a tale of ambition, deceit, and the consequences of corporate greed. If you found this video helpful, don't forget to give it a thumbs up, subscribe, and hit that notification bell so you never miss an update. Until next time, stay financially savvy.